Alrighty. So in today's video, I have the profit update of the income grid wheel strategy that I did on Amazon, right, in the last video. Now, if you haven't watched the last video, please go ahead and watch that video first so you can follow along. I'll put the link at the top right hand corner of this video so you can go ahead and click that and watch that first. So in this video, Amazon has gone up quite a bit since the last video I recorded. So I've got a number of requests to, just record an update, and along the way I've taken some profit as well. So I want to share with you what has happened. All right, so let's dive right in. So as you can see, this was where we last left off in the last video. So at that point in time, we have been exercised. Right, we've been assigned on the 100 shares at $85. So at this point, we have 200 shares, right? We have 100 shares at $85, and then we have another 100 shares at $90. And since then, Amazon, as you can see, have really rallied, right? It has gone up quite a bit. And this is where you can really start to take some profits off the table, right? You can sell cover calls. And I'm going to share with you the decision making process that I went through as the market went up. All right, so let's go back a little bit to where we last left off in the last video. So in the last video, it was mostly just cash secured puts, right? Because the market basically has just gone down, right? It hasn't really rallied up that much, right, compared to how it is right now. So in this video, I'm going to be sharing with you the covered call. So now at this point in time, where the market, right, is roughly around $82 plus, after you've got assigned on the 100 shares, you can actually choose to sell a covered call. So there are some people that, all they want to do is they just want to sell covered calls at the same strike price which they got assigned, right? So they got assigned $85, they want to sell the covered call, and there's absolutely no problems with that, right? So what you're essentially doing is you're just trying to get the premiums. You're just getting premiums over and over again, and you just don't care about the capital gains, right? Capital gains is where, if you're assigned at 85 and you sell the stock at anywhere above $85, you're going to have capital gains on top of the premiums which you receive for selling the covered calls. So at this point of time, let's say you decide that you just want to get the extrinsic value because you're afraid that the market might just continue to go down, and you want to quickly get whatever premiums that you can get to cushion this downfall in the prices. You could actually do that as well. So if you were to pull out all the call options at this point of time, you can see that there are a number of choices, right? So the strike price which you want to go for will be 85 because that's the price you would have get assigned at, right? So at 85, you can see that there are many different choices, right? So which one do you want to go for? And here's the short answer. There is no right or wrong, right? You're still going to get the premium, you're still going to make the money. So as long as Amazon goes up in the long term, you're going to be making all this premium, this income, as long as you just keep doing them consistently. So at this point of time, which one do you want to sell? So here are a few insights, all right, for you on how I decide which one to sell. So first off, you may want to consider selling the one which has the highest ROI, right? Some people want to say that I want to get the highest return, the bang for the buck on my investment. So if you want to go for that, this is how you want to calculate the ROI. So first of all, you want to take the premium. So let's say, for example, you take the one where there's there's 1 day left to expiration. So that's about 39 cents. All right, so you take the 0.39, and then you just divide it off by the strike, which is 85. And then what you want to do is divide by the number of days to expiration, right? So in this case, there's just 1 day left. So 1 day left, there's no need to divide it, and you just times 365 days. So as you can see, this is roughly 167% return, right? 167% return is really a lot, right? If you think about it on an annualized basis. But then you need to think that all you're receiving is just $40 for this one time. Now, what if the market continues to go all the way down? Let's say, for example, if the market kind of really tanks after that, then you would have kind of regret that you didn't sell, further days to expiration, the further one where you get more premium, right? Because you could only sell this once at this moment, right? That's just $40. But if you had sold the one at the 29 days to expiration, you'd get $436, right? $436 per contract, and this is actually quite a juicy premium compared to the one which there's 1 day, right? And the other thing that might happen is if the market was to really just shoot up, which eventually did, right? So in this case, again, you would have your shares most likely called away at 85 strike price, but then the only premium which you receive is just $39, right? When you could have maybe gotten more, right? 436, but then of course, the market could have gone down back then by then, but hey, at least you have gotten $436 in terms of premium. So these are things that you really want to take into consideration when you're, choosing the right strike for you, right? Again, there is no best strike, right? Because you never know what the market is going to do, right? The only time I would say that this 1 day left is good if you were to sell at the same strike which you got assigned is if the market just stays somewhere around here, right? It just stays somewhere around here the next few days, and then after this expires, you can sell it again, right? You can just keep selling and selling and selling it over 1 day, over and over again, or the next expiration date, once this expire, for you to keep getting the highest return on your investment, the highest ROI. So we never know what's going to happen. You just want to choose one that you feel comfortable with. All right, so let's take a look about the ROI for the second one. As you notice that as more days there is left to expiration, the ROI will actually drop. So there's kind of a trade-off. You get higher premium, but you get a lower ROI compared to the shorter DTE option. So let's take a look at this one. So you take 1.68 and then you divide it by the strike price, 85. So this time you divide it by number of days left, which is 8, then you times 365 days, you get 90.17%, which is pretty good as well. And let's take a look at the last one. All right, so you get 4.36, and then you divided it by the strike price, you divide by the days to expiration, that's 29, and you times 365, that gives you a return of 64.55. As you can see, the ROI drops off, although you get slightly more premium. So there's no right or wrong answer. You choose one which you are comfortable with and you can live with, depending on where the market goes after that. All right, so for me, I did not choose to sell the cover call at 85 because if you have already seen my last video, my plan was to sell it at every interval, right? At every grid interval. So this income grid interval is $5. So what I want is that when I get assigned on this, I want to sell my 85 strike shares at $90. And those at $90 that have been assigned these 100 shares, I want to sell at $95. So this way, not only do I get the covered call premiums, I also have a chance to get a capital gain of the difference, right, of this strike prices. So in this case, it's $5 difference. So that is $500 if my shares get called away at the next level. All right. So again, for this, there are always trade-offs, right? It's not saying that this is better. It's just that, I think that Amazon right now is pretty undervalued, and at the same time the stochastics, which is not shown here, is actually pretty oversold. So I know there is some sort of a bounce that is due soon, and if I expect that there's going to be a bounce that is due soon, why would I just want to sell it at the price where I got assigned when there's a chance I can get it at a higher price, right? So this is my consideration when I did it. Now of course I could be wrong, right? The market could go down and then I would have regretted not selling at this, or rather I would have gotten at least more premium if I had sold it at this strike price at 85, right? So at the end of the day, again, it comes down to where the market is, all right? So as you can see, the market rallied all the way to $90. So this is where I took a look at the cover calls, and this is where I decided to, sell my cover call. So again, I'm faced with 3 choices, right? You have the 3 days, you have the 10 days, and you have the 31 days. Which one do you want to go for? Right, so for me, the decision which I made, I actually went for the shortest one. I went for this one. And if you notice in my previous video, I actually chose, for the cash secure put, I chose the second nearest expiration date, right, instead of the first one. But for the cover calls, I chose the shortest one. And the reason is because, well, firstly, if you can see, the premium difference is not that great, right? So as you can see, for 3 days, you receive $190. But for 10 days, right, which is roughly 3 times, right, of this days to expiration, I only receive $257, or rather I would only get $257. That is much lesser than twice when I should be getting at least 3 times this premium. So there's not much difference. So the other thing, that the reason that I chose this is because right now I don't just have the premium of this cover call that I'm going to receive. I'm also going to receive the capital gain from $85 to $90. And as much as possible, I want to capture this profit, right? Because this is a pretty big profit compared to the premium which I'm going to receive. So the last thing I want is for the market to go back down again when I already had a chance to sell it at a profit for the capital gain side. So I wanted to get out of this position as quickly as possible to realize these capital gains. So that is my first priority, right? So that is why I chose the shorter days to expiration. Now, if you wanted to choose the longer ones, right? Because if you believe that the market is still going to go up all the way in the next 30 days, then there's nothing wrong going for the 31 days. You get $555. So you get $555 on top of the capital gains of $5, right? So all comes down to your own expectations you have in the market. I chose the shorter one. All right, so in this case, I actually put a limit order for $2 because I wasn't able to stay or rather stare at the market throughout the whole market, all right, close, right? At the open of the market, I only trade for like an hour or two. It didn't reach this price. I just put a limit order and I wake up to see if I get filled or whether it does not get filled. So in this case, I only got filled the day after, right? When the market shot up after that. So that's where I got filled. So I sold a cover call at the 90 strike price at this $2 in terms of premium with 3 days left to go. By the way, if this video has been helpful to you so far, I'd really appreciate if you hit the thumbs up button and also subscribe to my channel so I can create more videos like this for you in the future. Alright, back to the video. Okay, so as you can see, I got filled at the next day, right? The next day you can see the market really shot up, went all the way to $95. So at this point of time, it actually gave me the opportunity to sell my next covered call, right? So the next covered call that I sold will be at 95 strike price, and this time I'm able to get at the same days to expiration, the same date of expiration, and there's 2 days left to go. So you can see the market really did a U-turn, very strong rally in the next few days after we got a sign. All right, so again, down here there are a few choices that you can go for. So again, for this, I went for the shortest expiration date because I want to get exercised, or rather I want to have my shares called away at $95. So this way I also gain the capital gains from $90 to $95, and I have 2 days to go for it. And at the same time, if you were to take a look at the stochastics, which is not shown here, the stochastics is showing that the market is going into the overbought region, and there's always a chance that when there's such a strong rally, right, there tends to be, you know, quite a little bit of a pullback first, you know, before eventually the market goes up or maybe it goes down, right? So if I wanted to get out of my position and I expect that there could be some sort of a pullback, then I want to get out of my position as quickly as possible, because this way if the market does really rally, if the market does go back down after my shares get called away in the next few days, then guess what? I can again sell the premium. Let me just remove this drawing. If the market goes up and then comes back down again, and then I get exercised or have my shares called away in time, it comes back down, I can sell my premium again, the cash secured put at $90. It goes further down, I can sell it again at $85. So this way, I'm always trying to maximize the premium which I receive when doing this income grid wheel strategy. So for this, I did it at 95 strike price. I sold the cover call on 95 strike price and I got $2. Again, I just placed a limit order and then I just went away from my computer. All right, so there's no need for you to actually stay in front of the computer because you're not doing day trading, right? This is not day trading. This is more of a longer term, mid to a long term trading strategy. All right, so I chose the one that is at 95 strike price at 2 days and for a $2 premium. So as you can see, the market continued to rally, and at this point we got our shares called away. So that is a very good news for us because we managed to get the premiums. On top of that, we got capital gains from 85 to 90, and then we have the capital gains as well from 90 to 95, and all we have to do right now is just wait for the market to either come back down before we initiate at the $90 again, or if the market continues to go up, then I may reassess the whole situation again and then adjust the income grid. All right, so if you've seen in the last video, my income grid started at $90, right? Because the time when I take a look at Amazon when it decided to do the wheel strategy. The price was roughly around this bar down here, right? So I waited until it went down to 90 before I started the income grid. Now, if the market was to continue to go up, right, then I may readjust the income grid. So that's the beauty about the income grid wheel strategy. You can adjust according to your own expectations of the market. You can adjust, if you feel that you want to capture more profits as it's closer to the market. There's no right or wrong here. It's all really up to you. Okay, so let's take a look at the total profit so far. So for the cash secured premium, the profit so far which I received from selling them, it's about $850. And then for the covered call premium, it's $400. So just from the premiums alone, I've gotten roughly about what, $1,250. And then from the capital gains, you can see it's quite a hefty return as well for an additional $1,000. And that is $2,250 in total for this income grid wheel strategy. And we only got fill on just these two levels, right? So hopefully the market could still continue to be bouncing back and forth around these few levels. So this way we can always just keep selling the premium. All right, now the next thing I want to bring up as well is one of the subscribers which I had, actually a few of them have asked, regarding where does the rest of the capital or the money, where do you put it, right? For example, for this grid, let's say you have the income grid, you have a few levels, right? So let's say you have a few levels. Let's say, for example, you go all the way down to $50, right? So at this point of time, you notice you only get to use two of this level, sorry, at $90 and at $80. So only these two capitals is being used, but the other capitals below $80 is not being used. So what do you do with them? Are they just being set there idly, or do you do something with it? So for me, I personally put them into fixed income securities, or what you call money markets. So this way you're actually getting interest in the short term, right? You're getting interest before putting your capital to use. So this way, right, it doesn't sit idly there. Otherwise, it will be pretty much just rotting away in terms of a return, because right now in the current interest rate environment where the interest rate is pretty high, you do want to have your money working for you. So it's only when the market goes much lower then you activate the other capital which you have. But then again, this is your own choice. This is something, your own decision. You could just put all the capital you want into your trading account and then just use them solely for trading, or you could just put them in the fixed income securities or money market. So this is what you can consider doing. In terms of what fixed income securities, what money markets, this is something you want to go ahead and research for yourself, because different countries have different kind of securities, right? If your own country, you have your treasury bills, you have your maybe you call it fixed deposit, time deposit, that just gets guaranteed interest at expiration, right? This is something you might want to explore for yourself, right? So alright guys, so I hope you found this video helpful, give you an insight of how you too can do the income grid wheel strategy for yourself. So guys, I hope you like this video. If it has been helpful for you, I appreciate if you give me a thumbs up and also subscribe to my channel as well. And as always, thank you for watching. I appreciate your time, and may the options favor you.